Hey guys, what is up? It's Arthur here. Welcome to this video in which we are going to talk about Qualcomm and look at their financials and fundamentals to see what's the potential in this stock. In the last video, we took a look at Nvidia, which also looked very promising. So if you're interested in that, go check it out. It's a very interesting one. And in this video, we're going to look at the chip manufacturing business from a different angle because we're taking a look at Qualcomm. And Qualcomm is developing and commercializing foundational technologies and products used in mobile devices and other wireless products. So we are manufacturing chips, as is my best guess, because I know Qualcomm for their phone chips. You can read the rest of this, but I guess mainly we're doing chips, but you gotta know more about that. All right, so company size, market cap, call it 170 billion. Nvidia was 2.75 trillion, I believe. So this is roughly 6-7% of the market cap of Nvidia. So this is a much smaller company, but let's see what they can show us. So first of all, 5-year revenue, we want this increasing, and we can see that we went from 23.5 billion up to 39 billion. It's not the most linear growth, which you would ideally want because that is more predictable. So we had a bump in 2022. I think that's when ChatGPT got released. I guess they got a lot more orders, and just basically the chip quantity requirements from all around the world went up, probably leading to higher prices because production cannot grow so quickly as demand. And so there was probably a spike. There could be other reasons too, but there was this spike in the middle. Otherwise, it's a very nice trajectory and very nice pattern. Nice growth there. We are up 65% on 5 years. That is very nice. And then if we scroll down second, we want to look at the net income, what remains, and we see that we went from 5.2 billion to 10.1, almost doubling it. That's a 94% increase. And there is again, obviously more remains from more in most cases. And then we had a dip on the very next year. So this is more of a wobbly line here, but the average is roughly 9 billion. So if we go and take that 9 billion that they earn in net income every year on average, you can divide the market cap by that number, and you get that the 5-year PE ratio is less than 20. So that's a check mark. It's 18.95. I think this is the first company that we have had that is reasonably priced on a first look basis. And this number tells you that if you buy the company today, if they continue to keep having this average net income number going forward, it's going to take your money roughly 18.95 years to make up for what it cost you to buy that share in the company in terms of the money that the company earns. And so what I like to do, and I want you to get into the habit of looking at other companies. That's why my fourth item is to compare this number to the industry, to peers, right? Because there are some industries where the average is just lower. So you seeing, I think it's insurance and other companies like that, where those companies trade at like a lower PE. So them having a low PE is not anything to wow. So you gotta compare that to industry peers. And in this case, this is 24.16. So it still is cheaper than competitors, which is a good sign. So that's a check mark. And next up, you wanna look at return on invested capital. This is a number, this is a percentage that shows you if $1 gets put into this business, how many cents they are going to make on that. What's the percentage that they can convert? Market average is 9 to 10%. They can achieve almost 30%, which is very good. Looks like they have some staying power and some sort of moat around them. What I would check is, since Qualcomm, I know Qualcomm for manufacturing phone chips, I would check which phone manufacturers use Qualcomm, probably also how long they have been in contract, and whether any of those contracts are new, whether any got canceled, and like what are the trends, how many phone manufacturers are using Qualcomm versus others, what's the market share that they have. So these are all things that I cannot show you in this video because that would be a really deep dive. If you're interested in that, let me know, and probably we can find a way to make that happen at some point. So this is a good number, but there is more to look into after watching this video, which I will trust you will do. And so next up, since we know how much money this company generates, let's go back to the financials, income statement, and check how many ways we have to divide that if we are investing in this company. So we want to look at 5-year shares outstanding, and we have went from 1.15 billion down to 1.13 billion. This is negligible. It's a 1.7% decrease, 1.74. It's not much, it's very tiny, but it's not negligible for the fact that it is decreasing. So that is a good sign. I like the tendency. It's not much, but it's happening. So that's a check mark. And we are at 6 check marks so far, which is incredible. So let's see if we can find some more. Next up, we're going to look at their long-term liabilities versus their revenue. So in what rate those have grown. So if we go to the balance sheet, I'm just clicking through my handy Excel sheet, Google Sheets to be exact. You can find these numbers in the balance sheet. Long-term liabilities is not going to be listed in most cases. So what you do is you take total long-term liabilities and then deduct the current liabilities, so you're left with the long-term. The difference being current is due in 1 year, long-term is more than 1 year. Anyhow, you take total liabilities and you deduct total current liabilities, so you get total long-term liabilities. I might have misspoken there. So this is what we are left with, and this decreased 11, almost 12% over 5 years. And then if we go look at the first card, we can see that the revenue is up 65%. So that is a very good number to see, because your liabilities decreased by 11.85% while you managed to grow your revenue 65%. So that is incredible. They did manage to grow without taking on more debt. We'd like to see that. That's another check mark. Now, onto the cash flow sheet, probably my favorite. And we're going to look at how much money they have left over. This is hard cash. This is harder to manipulate than net earnings. So I like to base more of my analysis and ratios on free cash flow. You get free cash flow by taking net operating cash flow and adding the minus value here. So plus minus is minus. You can calculate this for every year and average that. MarketWatch also gives this to you on the bottom. So you average this, and you would get an average of $8.18 billion. And it is up from 4.4 billion to 11.16 billion, which is huge. This has grown a lot more than revenue. I'm not sure it is the exact same, like, what do you call it? I'm not sure it is the exact same, not ratio, but like the amount of growth that you can see. Roughly the lines, the tendency looks the same, but we have had this smaller number here, and we also had a dip in 2022 where, interestingly, revenue and net income was the highest, but free cash flow was lower. Anyhow, we are up 150%, so that is a 2.5x. So it is a very interesting question whether this is likely to stay and where this is heading. It is a very nice upward trajectory. It's a bit of a wobbly line, a bit harder to calculate with, but the tendency is good. So that's another check mark. And now that we know how much free cash flow They have average in each year 8.18 billion. We can take a look at those long-term liabilities, this cell right here, taking in only the last year because it comes from the balance sheet, and the balance sheet just takes a snapshot of the business. So it's kind of not relevant in terms of long-term liabilities, what was the case in previous years. So $18.38 billion compared to $8.18 billion of free cash flow every year, it would take them roughly 2.25 years to pay it off, which is a very convenient and pleasant situation to be in. And one other metric I can show you is a little dashboard I'm working on. You can also compare, to get a quick look at their debt situation, you can compare the market cap to their enterprise value. Enterprise value is just market cap plus adding all the debt and subtracting the cash. So if you end up with a higher number than your market cap, there is a bit more debt in this business. This is not a huge difference, so it is all good. And we can see that they can pay it off in a very reasonable time. So that's 9 checks out of 10. Very, very nice. And I wanted to show you another metric that you can look at, which is if you take a look at their revenue and their free cash flow, you got to compare the two, and you don't want revenue to be higher. Net income. You're going to compare net income, either trailing 12 months or the 5-year average. You're going to compare that to free cash flow. You don't want net income to be higher than free cash flow because net income is easier to manipulate. So just be cautious. It is in a reasonable distance, a reasonable difference between the two, but you don't necessarily want net income to be higher because, again, that is easier to manipulate. And be cautious, be extra cautious in those cases. How does net income in the trailing 12 months is higher in the case of free cash flow, so that's good. But just keep in mind that you got to check into why this might be, how they recognize their revenue and net income, because all in all, I trust free cash flow more, and that in this case is lower. So pay attention to this. Okay, last one. We know 5-year free cash flow, 8.18 billion. We can also compare that to the market cap that they have, 170 billion. So if you divide this by the free cash flow number, you get 20.70, which is an X because we want this to be lower than 20. But this assumes, by this ratio, you understand that if you take the average free cash flow and you assume that is what the company is going to make going forward with zero growth, then the 20 ratio is sort of the benchmark under which it is not expensive, but assuming that the company would have zero growth, it would trade for a lower price to free cash flow ratio. But there is growth, so this 20.70 might not be that much of an X. And to put this into perspective, since this takes into the average of the 5 years, you can look at just the trailing 12 months, which is the past 4 quarters that they have reported. And you can go to this number. This is what I'm talking about. If you compare the current market value to the free cash flow that they had in the most recent 4 quarters, this number is just 13.3. Now this takes a lot of assumptions into account because you are just focusing on 1 year. But even then, 5 years, it's not a horrible story and is definitely worth looking into. 9 out of 10 is a very good starting point to do more research on this company. Again, I would look at how the market is evolving, how much security Qualcomm has in terms of who they can supply and where it's going. Consider the trend of how people are using handheld devices more than ever, I believe. So these are things pointing in the right direction. So I would be very interested if you could bring some counter arguments to this in the comments and let us know what else we should consider in our research. So I think that was it for Qualcomm. Let me know what your thoughts are and if there is any other company that you would like covered, and I will help you out on that. Thank you for your time. I hope you found some value in this, and I hope to see you in another video. Thanks. Bye.